This is your Wall Street wake-up call. Bayer making a $62 billion bid for Monsanto this morning. For more, let's go now to Simon Smith, the chief economist at FX Pro, with me now from London. So, Simon, does this deal make sense? A pharma giant buying a crop company?
If you look at the makeup of the two companies, there's a little sort of crossover in terms of where the revenue comes from, but there's been such huge deals in this area that it sort of seems more like a necessity that this sort of deal has to happen. It's interesting, though, the size of it being an all-cash deal. It's the biggest, I think, all-cash deal we've seen since 2008, i.e. just before the financial crisis. So that in itself is notable, number one. Number two, it's a big deal from Germany. And remember, Germany is not such a stock market orientated country as the US or the UK, where we see our stock market capitalizations around 130% of GDP. It's around 50% in Germany. Germany is much more about sort of small to medium-sized companies, the Mittelstand as they're known. So it's something of this size, this nature is sort of on the unusual side for Germany. So I think it certainly stands out for those two reasons.
All right, we'll certainly continue to watch those developments. Let's also talk about some of the other headlines this morning. We had a big meeting of G7 finance officials in Japan over the weekend. No deal was made to lift global growth, rather. How significant is this?
Well, we have the sort of main G7 coming up later this week, so this is sort of the finance ministers putting their heads together. But look where we are. We are, a good 5, 6, 7 years into depending how you time it, into a global financial crisis, which the ramifications of which are still continuing. So, having had a coordinated policy response in the early days, sort of late 2008, others joined in sort of early 2009, and everything else has gone thereafter. It's very difficult to sort of coordinate things now. Policy is at the extreme in most countries. Unconventional measures have been implemented, and the needs are diverging. So yeah, Japan needs a weaker currency.
And they're not getting it.
The US doesn't really want to sort of say, well, no, exactly. Number one, the US doesn't want to see it. Number two is that, from many aspects, you can't really argue that the yen is overvalued. If you look at the yen in the bigger picture, it's done a very big move. The recent move we've seen is not that big in comparison. Plus, you can make a case fundamentally that the yen should be stronger. You've seen a turnaround in the sort of current account balances back into positive territory in Japan. So the US is sitting there thinking, maybe so, maybe you want a weaker currency, but we don't want to see a stronger dollar.
And just very quickly, do you think central bankers across the globe are out of options? I mean, we already have negative interest rates in Japan and Europe.
They are out of options. I mean, but also the effectiveness of those options they're deploying, i.e. negative rates or buying up other assets, is getting ever weaker. And also they can have consequences which are counter to what they actually want, and that's just the nature of having negative rates. You're not meant to have negative rates. You're meant to pay to borrow money, and that's the way it goes, and have a return of deposit. So this is a crazy world we're in.
All right, Simon Smith, the chief economist at FX Pro. Simon, great to see you. Thanks for joining us. I'm Scott Camp, and you're watching The Street.